Good day, everybody. This is Jim Kinney, a content provider for the OptionProfessor.com. And today is our weekly update that we give you every week. And this is for August the 24th, 2018. As always, I do remind you that past performance is not necessarily indicative of future results. And there is a risk of loss in both short-term trading and on option trading. So you should discuss that with your advisor, your clearing firm, and of course yourself to decide what, if any, transactions are suitable for you. Now, today I'm giving you my opinion and my views, and basically that is the long and short of what I'm going to do here today. Now, there is a lot of stuff going on here. We're making new highs on Friday here. I do have the quotes there for you. And so I'm going to go through some of these things briefly and then come back to them. You can see the dollar index is in the 95 area right there on your screen, the first one there. And you can see that the euro is at 116. You know, my view has been that the 96 area or so on the dollar index may provide a little resistance. So far, that's true. And the 115 level on the euro would provide a little bit of a base, and we could see a turning point off of those two numbers. It's still possible, although the dollar, was a little bit stronger than I thought by breaking through the 96 up towards 97 area, and the euro got a little weaker going down to the 113, 114 area. That right now has been temporary, so keep an eye on that. And if these are significant turning points, only time will tell. But my suspicion was that they might possibly be. So keep an eye on the dollar index if it can't get above 96, 97, and keep an eye on that euro if it can hold the 114, 115 area. And maybe in the months ahead, we could see the market turn over from that area. I'm going to go to the next area, oil. Oil was up in the 70 area, dropped down towards 65 area. Now it's at 68. You can see on your screen. And I'll get into the interest rate picture a little bit later. And agriculture I'll get into a little bit later, but I did want to show you a little differential in the metals area, which I thought was interesting. Again, I'll get into the stock market index. Well, I can show you that pretty quick anyway. Let me show you right now. S&P made a new all-time high, I think, today at 28.77, currently trading at 28.74 as we speak. That's up 16 points, so it has got a nice bid to it today. The NASDAQ is at 74.90, up 65, another big move on the upside. And you've got the Russell strong in the 1724 area, a little bit lower than its high of the day, which I think is the all-time high, 1728. So you see the stock market today is all having pretty good runs to the upside across the board, both the S&P and the Dow, of course, right there up 126. So that's joined in as well. So definitely we got securities moving to the upside. Okay, today, let's take a look here at what I wanted to do real quick before we jump into the stock market and the news that are happening is something that has been kind of interesting, and that is some people that are talking about spread trading between the gold and the other metals. Can you see the platinum there is at 789? It recently, I think, well, there you go, the low today was 774. Somewhere between 750, 774 has been the low area, ballpark. And then, of course, the gold did go down towards 1180, 1190. But let's just take a look at the relationship. 1212 minus 789 right now means that the gold is at over a $400, excuse me, the platinum is at over a $400 discount to the price of gold. And anybody who has any kind of historical knowledge of these metals knows that that is not the ordinary relationship. So some people are looking at the feasibility of being long the platinum and short the gold as a spread trade, looking for that $423 differential to tighten. That's interesting to me in some way, shape, or form. Again, check out the prices. Again, check out the risk before you proceed. But that differential to me obviously is fairly significant. And if you look at history, I think it would bear out that it's a little bit of an inordinate relationship. So take a look at that. Some people are investigating that as a potential value. And then silver. To the gold. You can see we've got 1,212 on the gold. And if you divide that by the silver of 1477, it was as low as under 1450. You are looking at a relationship, a percentage ratio right now of 82 to 1. And for a long time, 30 to 60 was kind of a relationship. And so if you think that the metals are in a constructive zone of support down here and they have any potential for rallying, there are those who believe that there is potential in the silver outperforming the gold if there were a turn, simply because of the relationship of 82 to 1 as one factor to consider, as the price of 82 to 1 relationship is historically a rather significant uh, ratio that would be indicating that silver is a little bit undervalued to the value of gold. Doesn't have to work out that way, but 400 bucks or better discount platinum to gold and 82 to 1 ratio gold to silver is certainly something to take a look at and sniff around. And I thought that was kind of significant, so that's why I brought it up before we get into anything here today. I'm going to switch over to the stock charts and the stock information here so that you can kind of get into more of the things that are more mainstream to you. But I just thought that that differential was kind of inordinate, so it might be worthwhile to take a look at. All right, here we go. We've got right here on your screen, up 140 on the Dow, up 64. The day graph here is showing that the market had hit a peak on the Dow and a little bit under it, and pretty much ditto on the Nasdaq, although it's closer to the high. The news that's coming up next week that I think for you to keep an eye on. Tuesday, consumer confidence is going to be coming out, as well as some trade numbers and some inventory numbers on both the retail and wholesale inventories. So the meat of the week next week is going to be very significant, I think, as far as news, starting out with that. And then rolling into Wednesday, which should be a very big day news-wise, because we've got the GDP coming out. And after that very strong GDP number that we saw, it'll be interesting to see what kind of pace is being kept. And also corporate profits are going to be announced or talked about on Wednesday. And of course, they have been very, very strong coming out of Q2. And then on Thursday, personal income. The consumer is 2/3 of economic growth. And obviously, that's why some of the stocks like Ross and TJ Maxx and Nordstrom and Walmart and some of the other guys, Target, have had a pretty good time of it because the consumers are out there spending some money. And so, again, the personal income being strong would be very supportive to the consumer stocks, and the consumer stocks, consumer discretionaries have been doing pretty good. Again, there is a index that I'll just put up here called the Retail Index ETF. It's XRT. And just to give you some evidence of what's been going on, let's take a look at it, and you can get an idea of what's going on there. Give me just 1 second. But again, the consumer has been very strong, and because of it, it has been a situation where they've been able to really get some backbone to the stocks that are in those levels. There you go. You can see it has been in a nice well, in the last 52 weeks, the low's been 58 and the high's been about 53 almost, and we're at almost 52. So you can see it's rolled over a little bit today. So I don't know that in the short run, it may have some rolling over to do. What I like to do in this graph situation is to give you the one you compare it to the 10-day, which gives you the last 2 weeks activity. Some of you people out there are short-term traders, and you are kind of looking for turning points. Let's see what you've got there as far as the 10-day graph, and see if we can get some indication of what the 10-day looks like. But you can see it hit a high point recently of 53 and has been kind of rolling over a bit. There's a gap in there at 52.5. I don't know if it'll try to go up and fill that, but if it doesn't, there is a little bit of a rolling over in the short run. But of course, that's a very short-term aspect. The overall trend clearly has been to the upside. On the retail sector, again, let's take a look at the moving averages and see if they're in an overbought condition basis the average or not. Right now, we're going to go down here, and we see the moving average on the 200-day is 46. The 50-day is 49. Can you see those numbers there? So they're inverted to the upside, which is a positive. And as far as how far away it is, it looks like it's only about 10% away from its 200-day moving average, which is not tremendously overbought. It looks to me any pullbacks towards 50 would be very important support. 49 to 50. Breaking under 49 to 50 would be more problematic. So if I was long the XRT, I would definitely be looking at a line in the sand around 49 or 51. If you think markets have come too far for any reason, there are a couple of hedging tactics that the Option Professor DVDs have that you could learn more about. One is the married put, where you're being long a put option in connection to your stock as an insurance in case the market were to roll over. And another insurance tactic would be the collar strategy, where you're selling out of the money call option, take in the premium, and then you use the premium to buy a put, and now you have your insurance that's been paid by the premium on the call. It puts a parameter on your stock, which means you'll have an upside maximum and a downside risk maximum as long as the collar is in place. This is a very effective strategy from time to time. If you're not aware of it, that's one of the great reasons to keep in contact with the Option Professor and get some more information on the DVDs that do show you in detail how those two strategies work. Because as you saw with Facebook and other stocks, sometimes they can fall very precipitously with very short notice, and you can't buy your insurance at a very good price after a hurricane's already hit, if you know what I mean. So there you go as far as the retail sector is concerned. Let's just see real quick what's going on with some of the big stocks in tech. Apple today, it has been obviously very strong after their earnings announcement, and of course, it's a very popular stock in all of the ETFs. So basically, you're looking at a stock that is one of the leading stocks in most of the big ETFs. And so as long as people keep plowing money into the ETFs, it does require these people to keep buying Apple. Apple hit recently a high at 219. It's currently at 216. And basically, it's a situation where the strength of Apple obviously is coming from tremendous sales, tremendous growth, and also tremendous cash reserves. Again, when you're looking at stocks, two of the things that are hitting me to keep in mind is the amount of buyback that has been announced by corporations. Is I have been told, read, it's over $1 trillion. I can't guarantee that number, but that's a big number, and I think it's one of the highest numbers ever. And then the tax cuts, in some people's view, have not been fully implemented, or the advantage of them has not been fully realized. And so that is getting people into a situation where they think that it could be helpful to see more upside with the tax cuts. I'm going to reopen my window here, so hopefully I'll be able to get you a little bit more faster results on the charts and keep the podcast going here. And again, the buyback situation coming, gives you either a possibility for acceleration, but it also gives you a little bit of a net underneath, knowing that the corporations do have that type of money on the sideline ready to buy their shares at some point. And again, that is one of the many reasons why people are discussing the idea of why the last part of the year may see a significant rally in the stock market. Some people looking for as much as a 10% jump in the fourth quarter, and that would take this S&P above 3,000 and take the Dow, up towards that 28,000 area, and et cetera. So let's take a look here and see if I can get some more stocks up here. There's a couple of stocks on retail that are just, really just look like they're almost out of business. One is Sears. And Sears is closing stores, and there you go. The stock is at $1.11. And this year has been a very tough year for Sears, as you can see, because the stock has gone from about $9 a share, almost $10 a share, down to $1. So it's lost 90% of its value. For those of you who like to investigate story stocks, obviously there's a very bad story there, but it's also a situation where it's only $1. And obviously, if they go into bankruptcy and the common goes to zero, you would lose the $1.11. And if there is some kind of a positive news of any type, obviously coming off the dollar price is also a possibility. And the other one in retail that is really gotten slammed is JC Penney, and that stock is at $1.80. It's up 2.25% here today, but you can see on that stock as well that it has been going down, down, down all year. It was as high as 4.5, and now it's down at $1.82. Today's low is $1.77. So basically, these are companies that are, closing stores and are having some very large difficulties. But that also sometimes opens the door for activity. That could be more positive, maybe a selling off of a brand, or maybe a selling off some stores or whatever. So for those of you who are looking for something that is extremely been hit and can only go to zero, if they obviously go bankrupt and then the common goes to zero, $1.82 on JCPenney and $1.11 on Sears are certainly getting down towards that number. No doubt about that. Okay, turning towards some of the other sectors, the financials have been on people's mind. So let's take a quick look at the financials. And XLF is an ETF on the financials. And let's see what that gives me here. Okay, XLF again is trying to break out. It's been having some trouble. There's a gap right there, if you notice, that has gotten filled. And so we really need to get above that 29 number, which it has been having difficulty doing. And if it can get above that 29 number, then I think the case of a further acceleration would obviously have some legs. If we were to break under 27.5 there, then you'd wonder what's going on with the banks. Again, loan demand, I don't believe is as robust as people would like to see. And with short interest going up and the long rates not going anywhere, obviously deposits are paid generally on a short-term basis, and loans are made on a longer-term basis, and that differential seems to be squeezed, and that might be one of the reasons why the banks have not had quite the legs people have been looking for. That could all change in the fourth quarter, and if the XLF were to start going above 29 and the news was turning on either, business activity or interest rates, it would be very interesting to see exactly what happened there. But right now, it looks like it's trying to get its legs, but it really could use a little bit more strength to confirm that that it has the legs. One stock that a lot of people were thinking because of a lot of deals going on out there, possibly the Goldman Sachs might be able to benefit from that. But the truth is that it had a very big drop this year from almost 275 area, right, all the way down to as low as around 220 or so, ballpark. Let me just see there. There you go, 220. So that's a pretty big drop. And now it's at a rebound up to 240. Looks like a triple top up there. And so if it starts breaking above 240, that would be more constructive to this. And you could even make a case, maybe it's forming a head and shoulders reversal there, with your shoulder coming in there and then the head down underneath 230 and then the other shoulder being formed now and the neckline at 240. So those of you who are interested in the financials, you might keep an eye on that because it is one of the more discounted names off of their 52-week high than some of the other ones, such as Bank of America, Citigroup, JP Morgan, and Wells Fargo, which are some of the more main banks that people keep an eye on. The industrial sector, let's take a look at that, because that's one that people are talking that could have some potential if the entire board is going to go. And again, it is not as extended as tech, but similar to the financials, it's trying to break out. It got above the 145 area. Now it's back at 145. So if this thing starts going, above the recent highs this week, they could be very constructive. I think this 140 number is, and this is the Vanguard Industrial ETF. There's many industrial ETFs. I'm just using this as an example. And, again, if it were to get above the 147 area, want to be constructive. Moving averages because they're based on time and price. And so let's take a look if I can get those up for you. On the industrials, yeah, you got they're inverted still. So again, that's not the greatest sign. The better sign, though, is that it is at 145, so it's above the 50-day, it's above the 200-day, but those two averages still have not inverted. The longer you stay above 140, though, it will drag that 138 back up if it can stay there for a while, because the 50-day average will be turning a lot quicker than the 200-day. Simple math on that, right? But again, there are those who believe that we're not that far from the moving averages on these, and so they do offer some upside potential. And your lines in the sand are not that far from the price. Some of these other markets, the price of the 200-day average versus the current price is rather far away. Let's take a look at materials, because that's another one that people have been trying to see if there's going to be any turn in. As you can see, it's been sideways. It looks to me like if it 35 and then the 138 area, there could be some potential in this one as well. This market, early in the year hit up 145 and it's been on the defensive. But if the economy and the GDP is going to keep a big pace going into 2019, there's some who believe that the materials might be able to benefit from that. Where's the moving averages there? 130, 133. So they're pretty tight, but they're still inverted to the downside, which is not the greatest sign in the world. But as you can see, it's trying to sneak out a little bit. It's 133.90. So again, as long as we can kind of hold this 128, 130 area, which is the 50-day average, and if we can get more upside, it's possible that the potential on that might be turning as well. I would like to take a look at some of the different things that are going on in addition to the stock market. Let's take a look at the transportation average. Some of the Dow theorists are very big on this being a indicator. As you can see, we made all-time highs this week on it at 470. And basically it's currently at 11. Has been a little bit of a rollover in the transport average, and I don't know if that's going to be a little bit of an indicator that we could see the major indexes roll over a little bit as well, or if this is just a little bit of a pause to refresh. That's possible as well. Looking at your moving averages on the transport, let's see how far away they are from their averages. And the transports right now are 10,584. So you're about, I guess about 10% or so, or you were at least 10% about over the 200-day average, which is not tremendously overbought, but it certainly is a little bit extended. And that might be one of the reasons technically why they might be having a little bit of a selling as well. Let's look at your S&P 500. And on the S&P 500, right now, we're at 2874. That made a new high here today, 2876. And let's see where that is basis the 200-day moving average. And obviously that 2800 number is very important. It's been tested a few times. As long as that holds, that's a very good line in the sand for short-term traders. If it breaks 2800, it would indicate that there could be some more significant selling behind it, technically. Let's take a look here. Yeah, you're at 2720 on your 200-day. So you are the better part of 150 points above the 200-day, and then your 50-day is right in where that support's been at 2800. That's what I'm saying. If you're long the market or you're being constructive on the market, that's a reasonable short-term line in the sand, 2800, and it's coinciding with the 50-day moving average. So keep an eye on those things. That would be, but the transports clearly have rolled over a little bit, and if they roll over more next week, again, these economic numbers next week. Again, the inventory numbers, the GDP number on Wednesday, and the personal income number, and of course, corporate profits. We had a very big Q2. If Q3 is going to start slowing down quite a bit, again, that would be something that might get some selling. When you get this kind of advance to the upside, there is a lot of people buying, but of course, there has to be a seller for every buyer. So you always have to ask yourself, if everybody's doing one thing, who's doing the other? And sometimes if it's a volume thing that's going to die out, then after the volume is filled in, if there's no buying behind it or no selling, if it was dropping, then it can reverse on its own weight, because obviously if the volume dries up on the buy side and people come in to sell, and the buyers are not there anymore, that's what causes things to drop under its own weight. An example of that could be something like Facebook, which ran up all the way to almost 220, got some obviously not good news, and there was not a whole lot of buyers when everybody wanted to get out, and you saw how fast it went from 220 down to 170 area. So that's a good example of you have to be careful after a big rally that if it does dry up, the selling can be fast and furious because the liquidity dries up. Okay, let's take a look at interest rates because, I don't know what that's telling us, but it's telling me that nobody's really counting on inflation to come back. And we're at 2.2 on. Now you can see when those GDP numbers were coming out, big numbers. People got concerned that inflation was going to come back, and they bid this. The yield on the 10-year Treasury went up to 3. Can you see it? Boom, right from 280 to 3. And it's died out pretty quick there, which, I don't know if it's telling us that Q2 was the best of what you're going to see for a while, or if the concerns over inflation just went away totally. The 30-year is not yielding very much. So you're at 282 on a 10-year. Let me show you what the 30-year is yielding. The 30-year Treasury is yielding 297. I mean, that's only 0.15 different between 10-year, which means people are not counting on any inflation to speak of in the next 30 years because obviously you're under 3% on a 30-year, debt instrument. And that is by definition a pretty darn low yield. So obviously, and of course, the gold might be telling you that the inflationary fears are certainly out of the window because that's been fading in a big way as well. What people are counting on and what might happen may be two different things, because with the tax cuts, you could be looking at a situation where the deficits could grow dramatically, and of course, if the liquidity of debt becomes questionable, rates can be very volatile. But right now, people are talking about inverting the yield curve, the 2 and the 10, or the 5 and the 30. We are getting closer and closer to that, and of course, some people think that's not a very positive event if it does occur. So that's when they're talking about a certain yield, like a 5-year yield versus a 30-year, or a 2 versus the 10, that type of thing. So again, a lot of stuff going on that way. Let me see what else we've got going here. Taking a look at the price of some other stocks that are out there. Google, let's see what's Google doing here today and give a quick analysis on it from the technical standpoint. And that's at 1217. It's up 12 points, but the high's been 1273. So obviously you've come off the high pretty good here. A very solid company and a very big company, no doubt about it. But again, it has not been making new highs here while the S&P's been making new highs. And tech is a very big part of the market. So we'll have to tech stocks. Google's one of them. What about Amazon? And Amazon as well was up at 19, pretty strong here, 1908. So it's hanging around its highs. I think let's look at a 10-day basis. That might give us a warning shot as far as if a certain level gets taken out. It might be a little warning that on the short run, things could bait a little bit. I would say looking at this graph here, you certainly wouldn't want it breaking much under 1900. And then, of course, under 1870 would be something to be concerned about in the short run on Amazon, which has clearly had a very, very big run up. Look at in the last 1 year, it's gone from 931 to 1925. So, when you hear good news on things, you have to at least give some respect to the idea that it might be a situation where some of the good news has been factored into the prices. Again, across the board today, we are looking at a situation where the major indexes are moving to the upside. And again, we are looking at next week with some pretty big news. So I would anticipate that we could see some volatility as we go into next week. If these numbers blow it out of the water with GDP, corporate profits, and personal income, and we keep getting a bid here, we could start that acceleration they were talking about sooner rather than later. If Q3, which I had been suspecting might quiet down from Q2, then again, somebody selling this big rally who is it, and are they just providing liquidity for people here on the sell side with some idea that this buying will not persist? And again, is the transportation rollover from its high an indication that next week we could see some selling? You never know exactly what the markets are going to do, and that's why the strategies of hedging that the option professor does have can be of value. So if you have any questions on that, simply email me at optionprofessor@gmail.com. And we can discuss different hedging tactics if you'd like to learn more about that, or if there's other markets that we haven't touched, or markets we've touched but only briefly and you'd like more information, I'm more than happy to give you a hand with anything that I can. Again, I'm Jim Kinney, and this is the weekly update for the Option Professor for August the 24th, 2018. Until we talk to you next week, good luck and good trading, and we'll see you back here next Friday.